In the trenches with reverse ETFs. We talked about them last week. Let's see if they make good trades today. Want to start with the VIX, VXX. It's the fear trade, volatility index. How are you trading it today when we see this light rally?
Traders have been using this for twofold. One, to make money when the market's going lower. It's been a great vehicle to the long side. We tried to show you guys these because these are like situations that traders get involved in. Everyone's like, I want to be like more like a trader. How do they make money on down days? Because every time you'd come home, your mom would be like, oh, Dow's down 500 points. Are you okay? Sometimes you can make money when the Dow's down a lot, and these are the vehicles. So with
Especially
the VIX,
if you're living with your mom.
Yes,
okay.
I don't live with her anymore, but she still calls me. She's still concerned every day. So the VIX is something I've been watching on whether or not the market's going to start getting or acting better. We looked at it last time when it seemed like the market was going to break above the lower pivot. If you look here, we saw it, and I was like, wow, we have a bull flag on this chart. So if you look here on the chart, you will see that it stayed intact after that recent breakout above 25. So with that said, the market pulled in late last week, and look at this move in the VIX. Another move from 35 to almost 42, and now it does seem to have some room up into the 50s. Okay, and that's a lot of volatility. If today on a down, update in the market, perhaps look to see if you could buy the VIX right around this 37 or maybe even 40. See how it holds in there. If for some reason the markets continue to rally today and the VIX doesn't sell off, that's a clue to me that the rally isn't real. It's just an oversold bounce. It could be based on Gaddafi being captured. It could be based on the fact that tomorrow
oversold bounce.
Yeah, or oversold bounce.
Yeah.
So that's a good way to know whether things are real or not.
And is it the same kind of strategy for the SDS, the reverse of the S&P? Would you still be looking at it the same way?
The SDS is just a caffeinated way to short the S&Ps. So if you look at the SDS, it's twofold. We saw it here. Remember the pullback we talked about? If you wanted protection for your portfolio on this pullback, if you had a lot of longs, it would have been good to buy in the 25 area. And now look at this back up to 27. So as you can see, market came in, this went up. Keep watching it. It's a good vehicle. Some people like to trade this because it's in the 20s versus the spiders that are 120 or so. So psychologically, it's easier to maneuver.
All right, let's round it out real quick with the FAZ reverse of the financial sector. So it was up over 5% on Friday, but still well off those 52-week highs. So does that mean that the banks have found some kind of bottom, or that they're going to drop a lot more?
It means that one of the reasons I hate these ETFs is because they don't correlate perfectly.
Okay.
Some banks did make new lows, some didn't. This is the weakest group. If we were to make another move below this lower pivot, it will probably be led by the banks to the downside. So you could use that as a vehicle to be short the banks, and that's FAZ.
All right.